Although term insurance is by far the most popular form of life insurance, there are other types of cover available. Family income benefit. Standard term insurance pays out a lump sum. This can be useful, but it brings with it decisions about how the money should be managed once immediate debts and other obligations have been settled. Some families especially might prefer a regular income after the death of the breadwinner, which is where family income benefit policies come in. This sort of policy provides a monthly tax-free income, which will be paid until the end of the term agreed in the policy. You can even choose to have the payment increase over the term to mimic would-be pay rises and increases in the cost of living. The biggest disadvantage of this type of cover is that the income stops once the policy term finishes. So if you take out a 25-year policy and die 2 years before it expires, your dependents will only receive an income for the final 2 years. Whole of life cover. If you would prefer your life insurance to last for your whole lifetime rather than a set term, you will want whole of life cover, which is also known as life assurance. Insurers tend to use the word insurance if there is a risk that something might happen within a given time frame, and assurance when something is certain to happen. This type of policy doesn't have an end date, so you pay for your premiums until you die, at which point the policy will pay out. Some policies ask that premiums are paid only until you achieve an advanced age, perhaps 85. As a payout is certain, life assurance is much more expensive than term insurance. It is also more complicated, as some of your premiums will go into investment funds and some towards buying life cover. This means that the amount that your dependents will receive when you die will be varied depending on how well the underlying investment has performed. Because of the way it is designed, whole of life insurance is not intended to provide for the unexpected and premature loss of an individual, and is more commonly used for complex financial and tax planning needs. Some term insurance policies can be converted to whole of life policies, known as convertible term insurance. Premiums for this type of policy are higher than for conventional term insurance policies. And once the policy converts, they will increase. Over 50s life insurance. The main appeal of over 50s life insurance is that anyone over the age of 50 will be accepted without the need for a medical, even if you've had medical problems in the past or are currently suffering from ill health. However, policies usually have a maximum age limit, which is typically 75. The policy might have to run for 12 or 24 months before a claim will be considered. If you die within this period, your premiums may, however, be refunded to your estate, minus a consideration for the insurer. The cover works in a similar way to whole of life insurance, as there is no end date, so the policy will pay out whenever you die. Premiums are usually relatively inexpensive, but the level of cover offered is also relatively low, in the region of a couple of thousands of pounds. Many people use these policies specifically to cover their funeral expenses. The biggest drawback is that you could end up paying premiums for a very long time. If you take out a policy when you are relatively young, you may end up paying much more into the plan than is paid out when you die. Some providers will also allow you to stop paying premiums when you reach a certain age, often 90 or 95. But if you cease paying before then, the policy will lapse and you won't receive anything.